we have 45 minutes. I have 3 beautiful humans who know a lot about crypto, real-world assets, and we're gonna do a spicy take today. We're gonna share some of the positive, but there's also a lot of criticism, I think, and a hard dose of reality that we all sort of need to acknowledge. So today we're gonna talk about what's happening in the infrastructure space and what is still needed, what's been built, what's still needed. And I think I want to start with, in crypto, we like to throw around all of these words, but we don't really agree on what these words mean. So let's start with the word infrastructure, because infrastructure could mean a protocol, infrastructure could mean financial plumbing, like infrastructure means something different probably to every person in this room. So Thomas, you're gonna get the first rough question, which is, as you think about the value chain for real world assets, how do you, as you approach investing, think about infrastructure as a theme? What's involved in infrastructure for tokenization in your view?
Yeah, thanks. So I think at a high level, if you zoom out, the way we kind of think about the value chain in a simplified way, you kind of start with sourcing, underwriting, structuring these products, then you get to issuance.
Sorry, you're saying a lot of words. So sourcing, underwriting, structuring, what is that?
Yeah. I mean, sourcing quality assets, underwriting, kind of like in the case of private credit, the type of risk that it is, thinking about how you're going to structure a transaction legally, financially, securing the financing. A lot of that lives off-chain today. I think where we start getting the process on-chain is more with some of the participants here today is kind of at that issuance level, bringing these assets, digitizing them. And this technology today is really well equipped to do what happens after the issuance stage, right? Kind of tracking the payments, the distribution, the reporting, enabling secondary trading, things like that. To your question of what we need more of, I mean, there's a whole lot of infrastructure that's missing, right? Things like credit scoring, credit default protection.
I'm gonna keep you on track with the question. Okay, so we have sort of this first step of sourcing, underwriting. Then we put the actual asset on chain, right? We do the representation of the asset on chain. Then we have a whole other life cycle. There's trading and liquidity, there's end of life cycle, there's accounting. Like, talk me through what happens once the asset is on chain. How do you work through disposition, reporting? Like, give me the rest of that life cycle.
Yeah, so I think in the traditional world, on paper, right, and the Centrifuge team's actually really well equipped to speak to this, as are my colleagues on our credit team that's working closely with Centrifuge and others. You've got like 14 cooks in the kitchen when it comes to calculating distributions, making those payments happen, reconciling that data on both ends of the trade. You have fund admins involved. This takes a while. That's why these securities trade and settle with T plus 30, T plus 60. This tech does a really good job at automating through smart contracts a lot of this once these assets are digitized, right? And it does so for the drop in tin structure, for things like Centrifuge. And so a lot of that can be a little bit more programmatic, and you have that single source of truth. That doesn't solve the entire problem, right? We need to find quality assets to bring on chain. We need to bring the data associated to those assets on chain as well. We need other parts of the ecosystem that more institutional participants, not retail in the crypto economy, are used to. Things like KYC, passport AMLs, or permissioned environments. I know we have Kinto as one of the sponsors here today. So in my mind, we've done a good job as this space in solving for sort of the issuance platforms that take care of a lot of this stuff once it is on chain. But sort of the adjacent pieces of the ecosystem that you need before you bring an asset on chain and that institutional participants need to want to get involved with folks like us, that's where we're still lacking. So I'm excited about some of that stuff.
Okay, so let's do a quick poll. Hold on, I'm gonna get to you next, Fabrice. So a quick poll of all 3 of you. What % of what's happening in tokenization and the infrastructure side do you think lives on chain? What percentage?
I can give it a go, kind of taking what our credit team is doing. So for those of you who aren't familiar, we have a BlockTower credit arm that is taking, in one instance, investment grade bonds and sort of re-platform them on top of Centrifuge while leveraging a credit line from Maker. For that, which was our first attempt where we're kind of like actually using dog fooding the stuff, we've probably put 25 to 35% of the process on chain, so still a low percentage.
Still very labor intensive.
Yeah, we're working with Maker as well to put T-bills for their treasury on chain, and there our team estimates that we're closer to like the 50th percentile. So I don't know, that's kind of our take. I'd be curious to these guys' answers
yeah,
as
what
well.
do you guys think?
I suspect given that a lot of what's happening in tokenization is happening behind closed doors in TradFi institutions where they have no intention of putting it on chain. So if you think of the overall AUM, it's a very low percentage that's actually on chain.
Yeah, single digits low?
Probably, yes.
All right, single digits low. That's T. All right, Chris.
I'm having trouble defining the numerator and the denominator, come up with the percentage. I think like the amount of assets that could be on chain and represented on chain is like minuscule relative to what's there in the market today, which is like 3 billion in total, I think, excluding stablecoins. And then of those assets that are on chain, like the portion of the actual servicing and the whole life cycle of that asset that exists on chain or not, like I'm under probably both of you guys in terms of like the percentage of the activities that are happening.
Damn, you're under. Fabrice had a very pessimistic take. So give us a number. We like numbers here. 2%. All right.
And
how
to
are you
be
feeling?
Clear, I'm talking about how much of the process we've put on chain, not what percentage of the assets, because
Sure. Well,
otherwise
the
I'm very
assets
much
are-
in this camp.
I don't even think we're at 1 basis point yet. So, we need to have dreams and goals. So that's not to be discouraging, but I do think it's important to be realistic because obviously there's a lot of optimism, but I think all of us, right, work in the business of asset management with clients and partners, and putting anything on chain is a pain in the ass. Very much so. All right, Fabrice. So your firm, FJ Labs, you're a little bit unique because you're not native pure crypto. You invest across a diverse set of industries and in emerging tech more broadly. So from your perspective as someone who looks at a lot of innovative technology across a whole host of verticals, what aspects of tokenization do you think are the most exciting? And then as you look at this, is it new companies you're investing in where you own equity? Is it protocols you're investing in? Like where specifically do you think as an investor you're going to make money?
So I take this at first principles. What do you want to tokenize? And basically, if you're tokenizing something, it means you want to access something that's transparent, real-time, efficient. And I look at where are there ledgers that are centralized that have a shit ton of intermediaries which are inefficient. And to be traditional finance is really the part that needs to be reinvented the most. I mean, we're in 2023, and it makes no sense that every year you have 57 trillion of payments where when you're doing a credit card payment, you have 5 intermediaries and there's a 1 to 3% tax. So payments would be one entire category. The second one is securities transactions. Right now, there's 100 trillion a year of equity transactions, but hundreds of trillions across all different types of securities. And when you think of the complexity of the supply chain, these are old centralized ledgers where you have broker-dealers, banks, custodians, et cetera. I mean, how can we be in 2023 and if I want to buy a stock, it's only trading at certain hours? You settle after multiple days and it costs multiple percentage points. This makes absolutely no sense. So to me, the biggest opportunity and the most logical one is moving to tokenization, both payments and TradFi, basically all this asset tokenization of all the traditional assets.
Yeah, and I think one of the themes we are going to talk about that we'll bring up in a moment is this idea, I like to use this framework of, when institutions do start tokenizing, whether it's equities or debt or other more esoteric assets, are they going to build it themselves? Are they going to buy it? Or are they going to partner? So I'm going to come back to you on that question because you have experience with this. All right, Chris, we're kindred creatures, my friend. You are at a firm that does venture capital. You have a trading arm. You have an asset management arm. You have a custodian as well. You do a lot of things at Galaxy. And you have a lot of different competencies and capabilities in-house. So as you look at your organization and tokenization becoming our more prominent theme, what are the biggest needs at Galaxy within your firm to support this new thematic? Is it technology and process related? Is it more tied to standards and interoperability? What do you think, as you look at your organization, what are the things that you need at Galaxy that you don't have today? Or are you able to leverage a lot of what you've already built?
Yeah. Unfortunately, I think the number one thing that we need at Galaxy is a hardened view and a better regulatory environment to be able to actually let these assets migrate from real world to a digital representation and actually trade and really open up all the potential. We think a lot at the firm all the time about what can we proactively do to push the space forward. A lot of times that involves us providing capital. So our venture capital arm, like a lot of the folks up here, is meant to sort of take our capital and our investors' capital and get it into the hands of the people who are allocating it most intelligently to the best things. And so we do that proactively. We don't own a custodian, but we bought GK8, which is a custodial technology company.
Oh, sorry, that's yes,
it's
different. Important regulatory distinction, I'm sure.
No, it's important because part of our thesis on that was not just as cryptocurrency traditionally becomes more proliferates, but also the tokenization of everything. That now means that big institutions around the world are going to have to touch private key material, and they're going to have to secure it. Because the reality is this stuff all turns into bearer assets, and so the actual custody of the key material becomes infinitely more important than custodying a paper stock cert. So GK is about providing technology, hardware and software backbone to other institutions who are going to custody this key material. So those are the things we do proactively. On the regulatory side, if we go back to first principles, this is really about, in addition to efficiency and cost savings, I think it's about access. And the regulatory framework that is in place is not built to give individual people access to all kinds of assets. It's just not, fundamentally. And so tokenization promises the ability to do that. Without regulation helping that, it's very difficult for us to have a big impact on growing TAM for tokenized assets.
Yeah, regulation. So I am not a lawyer. How many people here in the room have become part-time lawyers? Yeah, okay. We're all getting law degrees, you guys. Very exciting. Okay, so I'll do another sort of panel-wide question because I think it'll be fun. So we saw tokenization in sort of the last crypto cycle. It was a huge narrative. Do you guys remember T0? That was a whole saga. Who here remembers the T0 saga? And it was crazy, right? The fervor for tokenization and STO, security tokens. Now we're calling it RWAs, real world assets. We're in another sort of cycle. How many years out, in your view, do you think we are? Again, I love numbers, so we're going to pin actual numbers to this. How many years out do you think we are from seeing a material percentage of global assets on chain? Let's say the number is 10 trillion. I think that's a fair starting point. So that could be real estate, private credit, equities. We're not including stablecoins, so that one's out. But how long do you think it takes until we have 10 trillion of assets on chain, real world assets?
Question back to you. On-chain permission blockchains counting or not?
Permission blockchains are databases, so fuck no. Excuse my language. No permission databases.
That impacts my answer, but
Okay.
I'll let these guys go first.
Wait, what did you say? How many years?
I didn't say it yet.
Okay. Chris, I think you need to go first.
I go. I think it's a little hard. I actually think it's binary. I think it's going to be 0 to 1, right? The moment we have the ability to have tokenized equities, you're going to have trillions flow into it. So when does the 0 to 1 moment happen? I think within 5 years.
5 years. So single digit percentage, but 5 years. Okay, got it. Fabrice?
I think it's reasonable time expectations versus we're incubating a company to tokenize treasuries, which I think is easier to bring on chain for a variety of reasons. And treasuries is 27 trillion. Do I think I can see a few billion, frankly, within a year? Yes. To get a 10 trillion across all different securities. Yeah, I think 5 years makes actually a lot of sense. And again, the thing is, it's exogenous to us. It's regulation, especially in the US. When will this be allowed in an effective way? So we don't control that. We need to talk to Gary. But I think 5 years sounds about right.
All right, we're going to talk to Gary the Protector. But from what I'm getting, 2028 is going to be a great year for all of us.
I'm going to take the over on that. I think it takes more than 5 years to go to those numbers, closer to 10. Regulation
Let's dig into
alone,
that a little bit, though. Give us some.
Yeah, regulation
insight as to
alone
why.
is going to take a while. The bulk of these assets are traded by large institutions, which are still really shy about the space. There are big headlines, but it's mostly POCs. They're slow moving, takes them like a year to get buy-in to do anything, which they typically start acting on a year or two after regulation comes. So I don't know, in the US, I think more than 5 years.
More than 5 years. Okay, so not 2028. And maybe by the year of our Lord 2030.
Hopefully.
All right. I'm just trying to have some fun, you guys. Hopefully this is entertaining and insightful. All right, so Thomas, I'm actually going to come back to you. So I think one of the important things to sort of think about is who are the infrastructure providers, who are the players that are actually going to play and potentially win in this space. So let's talk about your portfolio. You ready? Okay, so maybe you could share with us 2 or 3 companies or protocols you're excited about and what gap they're filling in the tokenization landscape. And then I think the other important distinction to make here is, are these new companies built just to serve this real-world asset theme? Or are some of these companies, existing companies, that have a tech stack that you can use for the specific use case? Because I think there are a lot of companies that have been around for a while serving the digital asset space or the cryptocurrency space that are utilizing their infrastructure. Right. So 2 or 3 companies, and are they RWA specific, or are they just taking what they have and reapplying it?
Yeah, so that's a great question, and always happy to speak about the portfolio a little bit. We have backed 4 or 5 companies in the space in the past 24 months or so. Some have been at the more public network end of the spectrum, catering to the crypto economy, to your point.
Names.
Those include Centrifuge and Maple on one side, so companies that are launching a network for tokenization, networks governed by tokens, catering really to bring these assets on chain for crypto treasuries at large, or for wider access to retail, to the earlier point that was made. At the other end of the spectrum, we've actually backed PVO1, which is Max and Flavio, formerly from B2C2, who are somewhere around today. And they're going at it, and I see a hello in the first row. And they are going at it from a more sort of company institutional lens to begin. Obviously, in crypto, approaches often converge. So we'll see, let's check in 2028 or 2030. But
2030. 2030 is the year you and I speak again, Thomas. All right.
And so we've really focused on the issuance platform so far.
All right, so Fabrice, same question to you. Give us 2 or 3 companies in your portfolio that you're excited about.
Yeah, the one I'm the most excited about is the one I mentioned in passing, which is Midas. It's basically a German regulated company under European securities law that is tokenizing to start T-bills, but ultimately all other asset classes. And so it's basically issuing staked USD or STUSD. And when you think about it in the long run, it doesn't make sense that we're all trading in these non-yield-bearing stablecoins, USDT, USDC, et cetera. I mean, the people making money are Circle or Tether, but you are holding these for no reason. In the very, very long run, I actually think people should be actually not, why do we have a checking account, a savings account, as opposed to be actually transacting directly in a yield-bearing product? So I actually think in the very long run, a yield-bearing stablecoin like STUSD offered by Midas, not available in the US in the short term, because we are issuing a security and we follow European securities law, makes a lot of sense. And it does a lot of things, right? If you have a stable coin and you have treasury management, you're earning 5.5% as opposed to 0%. And if you borrow against it, which today the DeFi yields are lower than real world asset yields, you can actually, with leverage, essentially reasonably safely for the short term, earn 20+% on your T-bills. So there's 100 million AUM on it. It's really cool. So that's the one I'm the most excited about.
Okay, so let's dig into Midas a bit more. So inside of this tokenization value chain, what specifically are they doing or providing in that process? Because they don't issue the T-bills, right? But they're digitizing them. I presume there's a mechanism they have for doing that. Are they offering that as a fund? So talk us through what they're actually doing on the back end.
Sure. So you send them USDC or USD. They will KYC AMLU on the on-ramp.
Very important. Very important.
We're issuing STUSD, which is a representation of a treasury. They're actually buying the treasury at BlackRock in the institutional level, and it is yield-bearing. But then when you own it, you can actually, it's an ERC20 token. You can then trade with permissionless, legally under European securities law and German securities law on DeFi, which is where you can get leverage, secondary transactions, et cetera. So you can actually have access to the US Treasury market, even if you're not US banked customer. The only thing is if you ever redeem, the off-ramp is also KYC AML. So it's great because it's permissionless on the DeFi side, but the on-ramp and the off-ramp is regulated.
Sounds thorny. Sounds tricky.
It's complicated.
It is complicated. I feel like that's the story of tokenization real world assets is it's like the relationship status, it's complicated. It's
Yeah,
complicated.
but how do you make it work in a legal environment, right? Like you want to be operating in a way where institutional investors are going to trust you. So you actually need to be regulated. So to me, the future of CeFi and DeFi is regulated, because there's no amount of DeFi where you're going to be decentralized enough. There's always someone that can make a change, and so people are going to go and question that. And so ultimately, you want to find a regulatory framework that works, which is why we picked Europe. Now, US, TBD. That's another day.
US, we've got issues. All right, Chris, I'm going to throw the same question at you. And you can dial a friend if you need to.
Yeah.
I think Will is over there. 2 or 3 companies that you're excited about.
Sure. So we've been long-standing investors in Centrifuge. We've been long-standing investors in a company called Spectral now, which really started, which I think is one of the most important primitives for credit on-chain, which is sort of building an on-chain identity, on-chain credit scoring, sort of a la FICO, but with other characteristics that are necessary to identify sort of behavior on-chain. That's a great company. We just invested in Robert Leshner's new company, Superstate, which is tokenized asset manager that's launching, which we're excited about. And then we're also focused, less known as a company called Jukebox, which is bringing music royalties in tokenized form.
Tokenized music.
Yes, ma'am.
Royalties. All right. That's exciting.
Yeah, I mean, it's an asset class that is understandable. It's understandable for retail in particular because they listen to it and touch it every day. And so, if they're going to be again, this goes back to first principles. If you're going to be part of the thing that creates value, why can't I own it as well? If I'm going to listen to it 1,000,000 times over my lifetime, and that's what makes the royalty valuable, why can't I also get a piece? Like, that's what everyone should be asking themselves. And so to the extent someone's building something and trying to get that closer to the value creator, that's what we're excited about. Royalties is a great use case for it.
Thank you. So Fabrice, I'm going to come back to you. So again, your firm, you invest in a lot of different verticals. So give us some insight. Non-crypto companies in your portfolio, are they thinking about tokenization? If so, what are they concerned about? And if not, why do you think that startups, other companies in other verticals are not viewing this as an opportunity?
So the quick answer is they're not. We have over 1,000 companies in the portfolio. Obviously, 100 of them are crypto, but the non-crypto ones, they're not, for multiple reasons. We're obviously in the middle of a crypto winter, so it becomes less compelling for people outside of the crypto world.
We're not sexy anymore.
I'm reasonably bearish in the next 6 to 9 months. We can talk macro.
Bitcoin's coming for you. Bitcoin's coming for you.
Yeah, Chris told me Bitcoin's going to the moon right before this, so I'm banking on that.
Depends when, but
you heard it here.
But look, the issue fundamentally is, I'd say twofold. One is regulation, right? If you're a fintech company, a TradFi fintech company, this feels too complicated for you. And number 2 is ultimately the UX UI in Web3 is today very complicated, and partly is regulatory, partly it's product driven, and normies just don't have an easy time moving into the space. And so no one's really brought Web2 UX UI sensibility to the Web3 space. And that is something that needs to happen, but are any of our traditional companies or portfolios thinking about tokenization right now? No, absolutely not.
All right, so no to the startups. Sad. Are there any companies, as you sort of look across the landscape, that you think are doing a good job onboarding not just large financial institutions, and we're going to talk about those in a moment, but companies across the broader sort of tech and innovation economy?
Yeah, I mean, Circle is probably the best example, right? And at the end of the day, if we think of what is the largest real world asset today, it's stablecoins. And they're doing a good job both on the institutional side and the consumer side. So I've actually really been impressed on the way they onboard, the way they do the transaction, et cetera. So yeah, Circle, I think, by far. And also large.
Yeah, they've got Shopify, PayPal, Visa, whole host of folks. Oops, I dropped my cards. All right, Chris, I'm coming over to you. So one big question I ask, right, like I said, we're similar creatures. So one where I sort of ask myself, there are a lot of different trends in crypto. We're now in the second phase of security tokens, real world assets. And the question I ask myself is, what role do we play in this, right, as crypto native investment firms, asset management firms? And then the second question, and this is something you probably think about a lot, do we build, do we buy it, do we partner with someone to support this new theme. So as you think about RWAs, again, in the context of Galaxy, what role do you think firms like ours that are crypto-native financial services companies are going to play? And are you going to build, buy, or partner to get these components?
Yeah, it's like the only question when you and I are thinking about what's long-term enterprise value for our institutions, I think.
For shareholders?
What's that?
We got to maximize EV for our shareholders. That's right.
And so I think that we can go about it one of two ways. We can either play the sort of, the educator role and spend a lot of our time educating the rest of the world on the topic and kind of offer products and services that helps bring everyone in. But then to what end? Like then all of a sudden when BlackRock and Franklin Templeton and everyone owns the space, like where is Galaxy, where is CoinShares at that point in time, right? And so when I think about future-proofing our business, that's why we launched the third division, that's why we bought GK8. It's really about, can we build and own some portion of the decentralized infrastructure in the future so that, because there's gonna be a phase after BlackRock and everyone else, where then they become intermediaries who little by little lose their edge and get disintermediated out. And so ultimately what's gonna be left, if we're right about the way the world goes over the long run, is we wanna ultimately have built and own and be a trusted node in the decentralized future. So that's our North Star, is along the way we're providing capital, we're doing a lot of cycles with all the institutions, institutional buyers, institutional sell side on trying to convince them why this makes sense. Ultimately knowing that we need to make sure we have edge and we're a trusted party in the decentralized future.
I think that edge component is a question I ask myself a lot, right? Because to this point, JP Morgan has their Onyx division. They decided to build, right? They built all of their own infrastructure to support JPM Coin, which is an internal treasury asset. It's a cash management tool that's tokenized, but they built that all internally with their own tech, their own team. Similarly, Franklin Templeton, I don't know any startups, right, or players in our space who worked with them on this new effort they're working on to bring, again, internal cash management and trade finance flows on chain. And as we sort of look at this slew of institutional news that's come out around a lot of banks, again, I think starting with the stable coins and internal cash management use case, they're not really working with companies in this space. So what's your outlook in that? Are we gonna see more teams, more institutions building internally? Or do we get to a point when valuations come down a bit where they might start looking around at potentially buying companies in the space? What do you think?
Yeah, I think with certainty, we've already seen a decent amount of small acquisitions, acqui-hires, actual buyouts from traditional companies looking into the space. I do think valuation has been the problem, for sure. And so what we're doing now is we're sort of playing this game in our space for startups where it's like, can I last long enough for the capital markets to reopen for me so that I can keep going it alone, or do I have to capitulate?
Yeah.
And
well, they got 7 years, 2030, right?
Yeah, but their capital might run out before that, unfortunately. So we need the capital markets open sooner. Depending on how that struggle goes, I think you will see a lot of talent be brought in-house to these big institutions, because I don't think they're going to be successful. Like even JP Morgan Coin, I don't think that works for JP Morgan. I'm not sure that works for anyone else's vision of what these markets should look like in the long run.
I actually want to give an optimistic take here. So they haven't been.
All right, give it to us, Fabrice. We need some optimism.
So let's talk about what Franklin Templeton has done, right? Like they've created a closed loop system that indeed has a few hundred million AUM that's doing well. But are they really doing anything really fundamentally interesting? Like it's not an ERC20 token. It's not tradable, permissionless in DeFi. You can't really get leverage on it. And so what they're building is it really doesn't have many of the elements that make the space special and interesting. And so do I think it makes sense as a first step? Yes. But if actually you really want to take advantage of what the promise of Web3 is, I think they actually are going to have to go beyond that. And at that point, the organizations that have at scale that have created true enterprise and equity value will be acquired. Now, do I think this is happening in the next 12 months? No. But there's historically incumbents have not won. Just because they don't want to cannibalize themselves, and their cost structures are typically too high. So I think ultimately the disruptors will win, not the incumbents.
I think you
Wait,
see
sorry,
M&A
before you
pick
get
up.
into it, Thomas, so Fabrice, for the startups and founders in the room, how many months of runway should they have to get to this critical inflection point when people start buying? What do you think, 24, 36?
24, yeah. Today,
24.
make
So
sure
you
you have
heard it.
24 months of cash. Yeah.
Yeah, get your money, get that cash in the bank. All right, Thomas, your view.
Yeah, I think we're going to see the M&A pick up before that for really two reasons. One, these large institutions struggle to hire and retain the right talent to build these tools. Like
You don't want to work at JP Morgan?
JP Morgan's one of the better ones, actually. I'm thinking, like, look how ridiculed the SocGen code got, mocked on social and by engineers for a bunch of good reasons when they did their bond stuff. Same for Stellar's choices. I think some of those design choices are a little questionable. Franklin Templeton with Stellar. So, like, I think for that reason, you're going to see companies realize that if they want to keep playing in this space, they're going to have to acquire teams and talent. And then, as much as I agree with Fabrice, teams should have 24 months runway. The reality is a lot of teams do not have 24 months runway and are not going to raise a flat round or up round. And so their boards are going to be confronted with, do we do a bridge to nowhere or do we try to sell this thing? And you're going to see a lot of try to sell this thing, and you
You're
might find
making me
takers.
depressed.
So I don't know. That's just my take. I think you'll see a lot of M&A in the next 12 to 18 months.
12 to 18 months, okay. Yeah, I mean, I think the big challenge, right, has been valuation. I feel we're tethered to a very unrealistic number, right? We need to adjust. Okay, so we have 14 minutes left. Do you want to do some Q&A? You have a great group of people here. You should give them really difficult questions. Are we doing Telegram Q&A, or how do you guys want to do the Q&A?
We are doing Telegram Q&A. I just asked the Telegram if they have any questions.
Yeah, do you have any questions? Otherwise, I'm going to get aggressive.
I mean, that's probably the best choice.
Please,
right?
dear God, ask questions.
If there are no questions, I don't want to impede. We got a question. Do you want to just shout?
Fabrice, you talked about like transferability of these tokenized assets. I'd love to get your thoughts about what the bigger opportunities are.
Okay, so I'm going to repeat your question. So it's for Fabrice. Fabrice talked about transferability of assets. What do you think the opportunities there are specifically?
So outside of the US, right, once you're in DeFi, access to let's take a step back, right? Like there's 100 trillion of equities traded annually. There's hundreds of trillions of bonds, et cetera. Should, I think, these be tokenized in a way that then they're available in DeFi? Yeah, the fact that you can do it permissionless is going to lead to massive volumes. So when does that work? It needs to start having the issuance in a regulated environment. So I think it'll start in Europe with companies like Midas and others. But no, I think in the long run, it doesn't make sense to be going through all these different intermediaries. You're just going to trade the assets and hold them directly. So I think, yeah, permissionless transactions are going to happen at some point at scale. Our bet, as we said, was about 5 years. But yeah.
So I actually have a question for you guys you never answered a question, Bruce. So the question was, is it going to be companies who raise equity capital, or is it going to be protocols or projects that have a token? So Chris, what do you think? Are we doing equity or tokens on the infrastructure side? Hold on, I'm going to let Chris go first, and then we'll get to Thomas. You get to go last this time.
I do come at this from somewhat of a US-centric lens, but I think it's quite clearly going to be companies in equity. Not to say that a protocol launch and a decentralized sort of open source building infrastructure isn't one that promises for a very different outcome and a very interesting one, but particularly given how important this infrastructure is going to be for regulated institutions to participate in, we don't really see a world where traction is going to be had in a decentralized fashion in terms of the thing that everyone trusts working on yet for a long time. I also, incidentally, I'm not sure that like the space has proven itself for that model to actually work at scale yet.
We're not doing Olympus DAO again?
What's that?
We're not doing it. Was it 3.3, like 30,000% yield? That was fun.
Equity.
What do you, I'm sorry, I'm a troll. What do you think, Thomas?
Yeah, two different markets, two different approaches is how I'd frame it. The crypto economy needs real world assets as form of collateral, as form of more secure yield generation, because to your point, the 3.3 stuff wasn't that sustainable. And so on that end of the spectrum, the networks do well. As far as Apollo, BlackRock, JP go, I do not see them interacting with public tokens anytime soon, potentially at all. There are a number of things we need to solve there to get there. So I think both live side by side, but the bulk of the AUM may live for more traditional institutional stuff on the more closed network approach. So equity.
No tokens.
Some tokens.
Some tokens, equity. I'm going to get to your question. I'm going to let Fabrice give his opinion, and then we'll come over to you.
Similar, mostly equity value with the fees being taken in percentage of AUM or transactions, the old traditional BlackRock model. And there will be DeFi applications where it will be built and for instance, for lending or leveraging, which will be in the DeFi ecosystem. For those, there'll be a subset of these applications. The token actually makes sense and the value can accrue to the token. But I think for the vast majority of the companies in the space, it'll be the equity with a real business model.
All right, if you're selling tokens, don't talk to these guys. They want
it's really hard for tokens to capture fees, let alone pass those fees back to token holders right now. So it's going to take a while before tokens can be network equity, right? Which then the lines are really blurry with your question if we ever get there. So I love Fabrice's framing there.
Yeah, well, and I think the fact that stable coins are one of the largest assets in the crypto economy is indicative of the fact that what people want is this medium of exchange quality, and USD is very optimized for that. All right, sir, you had a question.
Yeah, hi, Michael. I think is this on? Michael, you mentioned earlier, you said about 30% of processes are on-chain right now, and I'll open this to the floor. Which key processes are not? Why and what will be the last processes you think? For example, KYC, but anything.
Yeah, so I was referring to what our credit team's doing with Centrifuge, which again is investing in investment-grade bonds. So first of all, we're not issuing new products. We're investing in products that are already off-chain, and bringing those onto the Centrifuge platform. And there are a number of things that live completely off-chain, right? From the legal agreements to all the data related to these assets, through to like the custodian and fund admin infrastructure. The Centrifuge protocol can solve for a lot of these things, particularly the fund admin side, but we still need, from a legal perspective, to have real world sort of like third-party companies in the middle. That's probably, and you'll hear my colleague Kevin speaking to this later on. But yeah, I think like that's as much as we could push it to bring a securitization process on chain with this first iteration. We need the regulatory piece and frankly more robust infrastructure beyond the issuance protocols in crypto to be able to push that number higher. That's kind of where we're at. This is specific to private credit, right? I think if you talk about tokenized equities, things like that, the answer might be a little bit different for startups like Bakkt, for example. But as far as private credit goes, that's sort of as far as we've been able to push it from a BlockTower perspective.
All right, he's taking notes, Thomas. I feel like he might get pitched at some point. All right, Thibaut from Fairmint.
Hey, that was very interesting, the piece on Germany where like the securities were like permission on the on-ramp and off-ramp and then permissionlessly traded. In Switzerland also there's like a regime like this where you can, if you want vote and if you want dividends, you need to permit to like KYC. Otherwise, you can hold permissionlessly. Any chance of that happening in the US?
We got to call Gary.
So today you can do this in Liechtenstein, you can do this in Germany, and frankly, for a lot of the cool DeFi stuff that's coming, MiCA regulation in Europe is really interesting. I mean, look, the rest of the world is moving ahead with a very smart or smarter regulatory environment, ADGM in Abu Dhabi, in Singapore, et cetera. The US is in the dark ages. I mean, we're doing regulation by enforcement, which makes absolutely no sense. The fact that an institution like BlackRock has not yet been able to issue an ETF for BTC also makes no sense. I mean, it feels like, we're in 2023, we're so far behind. So I would like it to happen soon, but I'm definitely not holding my breath. And so a lot of the innovation here is going to come outside of the US.
This is purely anecdotal, but to your question, I have heard teams thinking like, we want to charge revenue, we want to pass that through to token holders, but we can only do so to accredited or qualified investors. And so they're like, maybe we set up a separate staking contract where if you KYC AML and prove that you meet that institutional threshold and you're not just a retail, Joe trading from his basement, then you can get dividends. And what's really interesting, if that were to, work and get signed off on legally, is like, you might see a lot of the token holder base get cleaned up a little bit, be less retail centric, even for tokens like Centrifuge or Maple, and more held into institutionals, but purely anecdotal and sort of just starting to work on.
And that was Aave Arc, right? Which was the sort of permissioned version of Aave, where it was institutional participants who had a KYC token, and there was very little volume there because again, the degens want to, slang, slang
mean,
their
look,
USDT.
This is the way Tom is describing it is the way we're thinking of launching Midas in the US to begin with. Accredited investors, KYC, AML, and no secondary transactions. But it's not super exciting, but it's a way to get in. But again, it's not the real vision.
All right, Chris, you look lonely over there. How you doing?
Doing okay.
Okay.
Yeah, the only thing I have to add to that part of the conversation is, like, I'm hopeful the US can figure it out. We have for centuries. We've figured stuff out and done a good job. Like, to me, it's all about actually doing the work and creating a lane. So,
What's the work? What's the work? Specify.
So Gary Gensler says, come register, right? That's his famous quote. I could tell you, for someone trying to register, it's very challenging. We actually run a company, let alone a decentralized protocol that doesn't have 3 years of audited financial history. Like, but it's not necessary for the thing you're offering. So if we did the work by coming up with a new disclosure statement for these assets, for example, that tailor-made appropriate disclosures that would get the SEC and other consumer watchdogs comfortable, but also allow things to register, then you wouldn't have to answer the question, because then it would be a security and you could sort of interact with it the way you would. So I think we should do the work constructively instead of doing the work destructively, which is what we're actually doing here in the US.
Kind of fun to be destructive, though. I'm kidding. We have one more question. Let's make it rapid fire, because we are standing between you and lunch, and that is a terrible place to be. So please go ahead.
Just a quick question. Has our industry over-indexed on transparency? Who cares at this phase about transparency? And do you see it as a bigger driver going forward?
Yeah, I'm going to take a first stab at that, and I think Fabrice and I were actually chatting about this in the background. It sort of depends who you ask, right? Like, if you're BlackRock, you kind of benefit from information asymmetry. You probably don't want your stuff to be public on-chain first. If you're a smaller issuer, might that be a selling point? If you're a retail investor and you see that you're the product, not the customer, you might start caring. So I guess my answer is it depends who you ask, but I care, and I don't think we're over-indexing, and I'll keep skating in that direction.
Yeah, same answer.
I agree.
We're over-indexing on transparency.
No, we're not over-indexing on
Okay, got
transparency.
it. We do want transparency. Okay, I just want to be clear. That's it. Thank you guys for sharing your deepest thoughts and truest feelings. Thank you, everyone, for listening.
Thank you,
Have
guys.
a great lunch.